Thank you very much and welcome everybody. In the next half hour, I'm going to distill 50 years of Wall Street knowledge down into a plan that you can use to protect your assets and make money in a bear market. I've lived through 8 bear markets and prospered, and this is the 9th. I also headed up the options department at a regional brokerage firm for 5 years, where I learned that options traders need a plan and need an edge. And so after the financial collapse of '08, I created the Chaikin Power Gauge rating, because although I'm known for my technical indicators, I've always believed that fundamentals drive the market. The big institutions look at fundamentals. Technicals are my way of monitoring what big money is doing, but now we're making the Power Gauge rating, and have for the last 10 years, available to individual investors and traders to level the playing field. So in the next 30 minutes, and this is a lot of information, but I grew up in Brooklyn where we learned to talk fast before we learned how to walk. We're going to look at 4 steps to mastering the bear. You've got to know what to expect in a bear market, so we're going to start with that. You need to focus on stocks that are likely to outperform or underperform, because stock selection is very important in a bear market. And we're going to show you how to zero in on the best long and short ideas using just 3 key indicators: 2 technical, 1 fundamental, the Chaikin Power Gauge, and then how to profit during bear market rallies using limited risk option strategy. And we've sure seen a doozy of a rally here in the last 2 days that was petering out when I logged in. So let's look at the SPY, the ETF that mirrors the S&P 500 index, the most actively traded instrument in the US markets. At the bottom of this 1-year chart is our Chaikin Power Gauge rating for the ETF. We have Power Gauge ratings for 5,000 US equities and ADRs, and also for all listed ETFs. So what happened was, as we're all painfully aware, we peaked in February at 33.94 with the economy starting to pick up a bit. And as soon as we sold down more than 20% on a closing basis, we were officially in a bear market. The correction at the low on Monday a week ago was 33.9%. And we've now, as of today's highs, had a 47% retracement. But Chaikin Money Flow, right under the price action, has actually stayed in the red, which is not a good thing. It should go green on a rally, and it's stayed in the red. So that's why I created that indicator over 35 years ago, to measure institutional accumulation and distribution. So we've had a lot of short covering. We've had a lot of wishful thinkers who are praying that the bottom is in. But typically in a bear market, especially when you go past 30%, you need to make a W-shaped bottom. You got to go down and test that low. And I know it sort of strains the credibility when you see rallies like this, but the next 2 charts will put this all into perspective. So since 1945, 11 bear markets. 8 of them have been contained in the 20 to 40% range. Average decline, 27%. We've already exceeded that. Typical length, 12 months. We did it all in 1 month. So there are people on TV saying, well, the faster you go down, the quicker you recover. And that's something I actually believe in. 3 of the bear markets went beyond 40%. The average decline was 51%. I think we have to be prepared for that, which would take us down to 1,700 on the S&P, unless we get a treatment and or a vaccine. And that vaccine, if you read the science, is going to take 12 months at a minimum. So here's a chart that shows you all the retracement rallies in bear markets since 1945. We've just had a 22.5% rally. That's at the upper end. If you look down that chart of the typical rally, they're usually between 10 and 24%. So we're at the high end. And you usually retrace somewhere between 22 and 50%. We've now retraced 40%. So again, we're at the upper end. Why is that? Very volatile markets. This one was triggered by a disease, not speculation, not a problem in the mortgage markets. So it's different this time. But the bottom line is, I believe you need a W-shaped bottom. You don't have to break the previous low, but you have to come back down and wash out the individual investor. Typically in a bear market, the leveraged institutions get washed out first because they have to meet margin calls and deleverage, and that's what we saw going down into that Monday low under 2,300. The individual investors are pretty sanguine, believe it or not. But at some point, if they haven't raised cash, and we've been promoting the idea that you need cash to sleep at night in a bear market, then some segment of the retail investor is going to panic near the lows. So how can you hedge a portfolio? Carly just talked about that. Using futures, for those of you who don't have a futures account, you can use put options on the SPY to hedge the risk of a retest down under 2100, so under 2300 rather. So what I've done here is use our options play module, which is embedded in the Chaikin Analytics software, and it suggested a high probability bearish put spread, buying the 260 put. That's this morning when the market was trading up around 270 or 2700 in the S&P. That expires on May 22nd. You want to give yourself a lot of time to reduce the cost, sell the 230 strike price put against it. Total cost of hedging a $27,000 stock portfolio, $600. That's your total risk. If you're a speculator, you can sit on your positions, as Carly suggested. But if you're a trader, this trade this morning offered you almost a 400% return if we go back down below 2,300 by May 22nd, which is an eternity in terms of the volatility we're seeing. So you can use the options to either hedge your portfolio or to speculate on the downside. So the problem we're all confronted with is how do we protect our assets and make money in a bear market? Our solution is Chaikin Analytics. It will enable you to master the bear. Mastering the bear is critical. You can do it. I learned this through painful experience, and now we've been teaching for 10 years in a bull market, but always aware that a bear market was coming. Underlying everything that I believe and that Chaikin Analytics is all about is that fundamentals drive the market, but that emotions drive the market to extremes. So for me, in over 50 years on Wall Street, the path to profits has always been to combine fundamentals with technicals. The problem is fundamental research is time consuming and it requires knowledge and objectivity. So that's why I created the Chaikin Power Gauge rating in 2010 in the aftermath of the financial collapse to level the playing field. It's a simple gauge, goes from very bearish to very bullish, but there's a lot of number crunching going on under the surface. I like to say that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. It helps you find the winners and short the losers, and it's your key to profits in a bear market. So what's in the Chaikin Power Gauge rating that's made it so successful of finding winners in a bull market, but also telling you which stocks to avoid and which stocks in a bear market are going to go down the steepest? 4 primary components, 20 factors: financials, earnings. Technicals are only 15% of the model. We bring in 2 other technical indicators on the chart, and expert opinion. The reason the Power Gauge rating has been successful is because it's based on what successful Wall Street investors and traders look at every day. The Power Gauge works because it's based on how the market works. Looks at value metrics, earnings growth, insiders, short selling, sums it up all into a gauge. And the performance has been outstanding. Through the end of 18, over a 20-year period, the average very bullish stock in the Chaikin methodology up 18% a year. The average very bearish stock flat, and that's after a 10-year bull market. So what you need to do as traders, or if you're managing your retirement plan, is shoot the losers. A good friend of mine, John Carter, who some of you are familiar with, does an annual webinar. He always brings out the one slide. Your job as traders is to shoot the losers, get them out of your portfolio fast. Let everything else flourish. Now in a bear market, and this is the Power Gauge rating in 2015, there was a bear market in energy stocks just like there is and has been for the last 15 months. The average very bearish stock in 2015, when the market was flat, was down over 17%. Energy stocks and small caps were in their own bear market, and here we are again in a full-blown bear market that's taken everything to the cleaners except for a couple of the biotech stocks. So let's look at a pattern that can help you find bullish stocks. Power Gauge rating is bullish. That means the fundamentals are strong. Stock is outperforming the market. And Chaikin Money Flow is strong, telling us that institutions are accumulating the stock. Now, as of yesterday, there are only 9 stocks in the S&P with a bullish Chaikin Power Gauge rating. There are a whole slew of stocks with a rating we call neutral plus. The underlying fundamentals are positive, those 20 factors, but the stocks in a long-term downtrend don't want to bottom fish. But Regeneron, which is in the forefront of trying to find a treatment for COVID-19, has all the characteristics of a classic Chaikin bull. We read the chart from the bottom up. Why? Because the power gauge rating is your go-to fundamental indicator. That's been bullish. Regeneron's been outperforming the market since early November, so the market agrees with the model. That's really important. And Chaikin Money Flow shows mountains of green, which tells me the institutions are accumulating the stock. When those conditions exist, we're looking for disciplined entry points. So this is one of the 6 pair of buy and sell signals that we have in Chaikin Analytics. It's an oversold buy. I borrowed this from Larry Williams. Stock with a bullish Chaikin power gauge rating gets oversold and makes an 8-day low. It's a great swing trading entry, good about 66% of the time. By the way, Chaikin is not registered with any federal or state agency, so these are ideas for educational purposes only. But at the end of this presentation, we'll have 2 trades that I actually put on yesterday, one today, that can help you see how I've used these indicators in my own trading account. So classic Chaikin bull, the mirror image is the classic Chaikin bear. Power gauge rating is bearish. That means the fundamentals are weak. It's underperforming the market, and Chaikin Money Flow is red, not green. So here's Occidental Petroleum. Power gauge rating has been bearish for over 12 months. It's been underperforming the market. This is our proprietary red-green heat map of relative strength. And the institutions have been selling all along in this decline. And we see these relative strength sell signals. And these signals happened to come when Chaikin Money Flow was weak. Stock rallied for 2 to 3 weeks, and Chaikin Money Flow didn't go into the green. That's a sign that smart money is getting out. Now, the relative strength sell signal is really powerful. It comes when a stock is underperforming the market, moves back above its 21-day exponential average, and drops below it. This is a great signal for swing trading. These trades tend to last 4 to 8 weeks. And you see 3 really good examples on this chart. They're about 70% accurate. So if smart money is selling the rallies, you want to be selling along with them. You would have been out of the stock ahead of that disastrous earnings report just a month ago. Seems hard to believe. So much has happened in a month. And we call these money flow sell alerts. You can monitor them on your online brokerage platform. Stock gets overbought in a downtrend or makes a new all-time high and money flow stays red, something's wrong. Smart money's getting out. Now here's a very painful example. In the same industry group, Whiting Petroleum, power gauge had been bearish for over a year. Stock was underperforming the market. Institutions were selling. The power gauge went bearish above 30, and sadly, last Friday, Whiting filed for bankruptcy. That's the extreme case, but we may see more of that in the energy patch. Price of oil doesn't hold the current rally price of $34 a barrel, there's going to be hell to pay in the energy patch. If you follow this discipline, you're not in the energy stocks. Now, what we're talking about is really a combination of fundamentals and technicals. I call it the dynamic duo. Chaikin power gauge to measure the fundamentals, Chaikin relative strength to tell you whether the market agrees with the fundamental rating. And that dynamic duo finds big winners and big losers. Relative strength is a powerful tool. Investors Business Daily, Zacks, Standard & Poor's have promoted this for years. Their research shows stocks in strong industry groups outperforming the market are the place to be, and you want to avoid weak stocks and weak industry groups. So let's look at an example of this dynamic duo. Here's Leidos Holdings. It's an IT company with aerospace ties. This is a really good stock for our subscribers in 2019. The power gauge turned bullish at about $50 on the way to 125. The market agreed with the model. Chaikin Money Flow said the institutions were buying. This is a third signal, money flow buy. You can see how it pinpoints low risk entries. And then when earnings were reported in February, the stock spiked up. And when you see a spike like that, bull market or bear market, sell the earnings spike. It's a gift. Take at least half your position off. If you're a trader, take the whole thing off and say thank you. If you got in under 100 on that money flow buy and you can get out at above 120 just 3 weeks later, take it. Don't be greedy. Here's the dynamic duo on the downside. Canadian Goose. Trendy apparel manufacturer. Power gauge has been bearish for over a year. The stock's been underperforming the market. Smart money has been selling the rallies. You see these money flow sell alerts. Just to be clear, when you get overbought and Chaikin Money Flow stays in the red, especially if the power gauge is bearish, that's a selling opportunity. If smart money is selling the rallies, you want to be out of the stock and shorting along with them. And this stock has dropped from over 55 down to $11 the other day. Think about that. So the second pattern that I want to show you is what I consider to be the key to making and keeping profits, which is spotting personality changes. So what is a personality change? It's a stock that's been happily outperforming the market that suddenly begins to underperform the market. And the reason that's so important is we tend to be stubborn as investors. We fall in love with stocks. A lot of people think Tesla is going to go to the moon. Maybe yes, not so bad. In February, not so good right now. So you need something to tell you that there are changes going on. It has to be objective. So that's why we created this red-green heat map. Here's an example of a bullish personality change in a biotech stock, Virtus Pharmaceutical, VRTX. It had been in a downtrend basing between 160 and 185. Stock started breaking out ahead of an earnings report in October. At the same time, the power gauge turned bullish. Institutions were accumulating this stock, so we're looking for buying opportunities. But the bullish personality change is the key. If you are bearish on Vertex, you've got to change your opinion. If you're looking for biotech stocks to buy, that's a powerful pattern. I always look for the first low risk entry point after a bullish personality change. We got one of those oversold buys in December, under 220. Stock rallied to 250 at the peak, and it made a new all-time high this morning. In a market that's down as big as we've just dropped, 34%, here's a stock that made a new all-time high, along with Regeneron. Now let's look at a bearish personality change in a retail stock. Kohl's power gauge rating turned bearish in mid-May. It had been underperforming the market, but in November, there was a bit of bullishness about retail, and Kohl's started outperforming the market. And then it flip-flopped, and it did so after a bearish earnings surprise. That's one of the factors in the model. You see the EPS colored red there in the middle of the screen. That means they underperform Wall Street estimates. So the bearish personality change and the bearish power gauge encouraged me to look for the first sell signal, and this is our relative strength sell. You can see the 4 to 8 week time horizon playing out. Another earnings report that did not get treated well. Power gauge rating turned bearish on Kohl's on May 15th at 50. The low 2 days ago, $11, down 80%. You need to sidestep these. Analysts are now recommending retail stocks. I think they're way off base here, too early. So 6 pairs of buy and sell signals in Chaikin. You can go to our website, chaikinanalytics.com, and we describe how these are computed. They're either filtered by the power gauge rating, so sell signal comes in a stock with a bearish rating, or relative strength. You need an edge. You have to have something to make the signals more effective. And what we also do, which is so important in this bear market, is we send out daily alerts to our subscribers. On the stocks that you're following, was there a buy or a sell signal? And then on any bigger universe. Now, why is this so important in a bear market? Because my experience as a retail stockbroker is that individual investors bury their head in the sand. They don't open their monthly statements on their IRA or 401k. they just wish it would all go away. It's a bad dream. Well, there are opportunities. So in October, still in a bull market, of the 50 stocks I follow, 3 of them triggered signals on October 2nd, based on the price action the previous day. Biogen, the buy signal at 227, and Kohl's, a relative strength sell at 49. Remember, we just looked at the chart. It was $11 2 days ago. So let's look at a chart of Biogen. That signal came ahead of an earnings report that turned out to be much better than expected. The stock spiked up almost 100 points. If you followed the discipline, could have been in that stock. If you were looking for biotech, there was your actionable signal. Now, Chaikin Money Flow was weak in there. That is our third indicator. 2 most important, Chaikin Power Gauge Rating and Chaikin Relative Strength. And the stock has continued strong today because biotech is the answer to this crisis we're in, this existential health crisis. But in every industry group, there's good and bad. And this is where this methodology that has gotten me through 8 bear markets can help you. At the same time, Biogen was going up to new all-time highs. Sage Therapeutics, SAGE, had a bearish power gauge rating, same industry group, underperforming the market. You can see in July that bearish personality change. Then we're looking for a sell signal. Institutions are selling. You got one gap down of 100 points when a test they had before the FDA got bad feedback. And then we got another sell signal here in February ahead of a bearish earnings surprise. That signal came at 60 on the way to $20. Trends persist. You just have to know where to look. So bullish biotech stocks, bearish biotech stocks. That's the difference between a bullish power gauge rating and a bearish power gauge rating. So let's look at 2 trades, one that I put on yesterday, one that I put on today. I want to follow the power gauge ratings, sell bear market rallies because we're looking for a W bottom. And these rallies are fast, as we saw. They can be as much as 25%, retracing 50% of the decline. You want rules-based entries, and you want to use some options methodology that gives you high probability options trades. So yesterday, I put on a put spread on Ross Stores. Retailer, they're closed down. They have raised some money in the bond market, but we had a reversal sell signal. Now what happened? Deutsche Bank recommended the stock. It spiked up yesterday from 74 all the way to 88, and this morning it traded up to 95. Because I had a put spread on, I was comfortable with it. When I went on the webinar, it was back down to 85. Peaked at 95 this morning, trading at 85 at 3 o'clock. So I want to take advantage of that by using options which give you limited exposure. So this morning, options play said if you're bearish on Ross Stores, which was as low as 58 just 2 weeks ago, you can buy the 90 put. Again, these are ideas, not recommendations. Expiring on May 15th, sell the 75 put against it to lower your cost. So the total cost of that trade is $200. The profit potential, if the stock drops back, not to 58, but to 75, it looks like it's heading there today, tomorrow, the next couple of down days, profit potential 650%. We're taking advantage of the fact that a brokerage firm went way out on a limb to recommend Ross Stores at a time when they have no business. I don't get it. Maybe they're going to be right. Same thing happened with Restoration Hardware. I had a put spread on it ahead of earnings. Wells Fargo recommended the stock. Ran up from 78 to 126. They recommended it at 106. Went up to 122 rather. Then it dropped all the way back down to 80. You've got to be careful. Brokerage firms only know how to say buy. And they're looking to be heroes and put things on their buy list and then take credit for them. Be really careful. You need disciplined tools. Now this morning, I did a put spread on PVH Corp. Apparel company, they've already reported earnings. They were not good. Supply chains are broken. This is Calvin Klein jeans and a lot of other apparel brands. We got an overbought sell signal this morning. The dynamic duo was bearish. The stock traded up close to 50. So when it was trading at 48, Options Place suggested that for $230, I could buy the 45 put expiring on May 15th, sell the 35 put against it to reduce my cost. Remember, the stock traded under 30 just 2 weeks ago, and my profit potential is 335%. So this is the way you can use options to protect yourself. We saw that in the SPY, or make money on these bear market rallies. There's going to be a couple of them before this bear market is over, unless we find a treatment very fast. So everything we've been looking at is in Chaikin Analytics. It's a proven stock selection system, actionable daily email alerts. Normally, Chaikin Analytics is $2,195 a year. That includes our ratings on all stocks and ETFs. It's an award-winning research platform. Most importantly, we have a dedicated support team that works with you, answers your questions, shows you how to use the system, and you get my weekly market insights and our Chief Market Strategist, Dan Russo's morning insights. You can go to chaikinanalytics.com/MoneyShow, and if you do, you'll see that the market's on sale, but Chaikin Analytics is on sale as well. If you subscribe today, you can save $1,000 on the cost of an annual subscription, reducing the price to just $1,195. Again, chaikinanalytics.com/MoneyShow, or call 877-978-6257.